We're going to be demonstrating problem E7-6 on page 320 in your textbook. You can also find the same problem in the Chapter 7 practice problems in the Chapter 7 folder in Blackboard in the Connect assignments. If you have not yet read Chapter 7, please do so before you view this demonstration. Also, you can find this worksheet that I'm using as part of this demonstration in Blackboard in the Chapter 7 folder in Module 2. You might want to pause this, print out that worksheet so that you can record the answers as we're working the problem. If you have read Chapter 7, you may recall that the main goal of this chapter is to determine an amount that can be used as the cost of goods sold on the income statement, an amount that can be used as the ending inventory on the balance sheet. There are 4 ways that you've learned in the chapter to do so. The first method, specific identification, is not actually a part of this problem. With specific identification, you go back to the invoices you used to purchase your goods, your inventory, and use the actual prices you paid for the items that were sold to determine the cost of goods sold, and the actual prices of those items left to determine the cost of your ending inventory. You'll be using that method in another homework problem. The methods used in this problem are the 3 cost flow methods, FIFO, Lifo, and weighted average. Regardless of the methods used, the first step of determining the cost of goods sold and ending inventory for any problem would be to make a chart to calculate the number and cost of goods that are available for sale. Problem information is up here in the chart above. So in our first step, let's calculate the number of units and the amount of dollars of the goods available for sale. You might recall from an earlier chapter, the cost of goods sold formula. We start with our beginning inventory and we add our purchases to determine the cost of goods sold. So that's what we do here. Here's our beginning inventory and there are our purchases. We're going to total to get the goods available for sale. So starting with our problem, we had 300 units at the beginning of the period. We had paid $12 for those. So we're going to be multiplying that out to get $3,600. Then April 11th, we purchased 900 units and we paid $10 for each of those. Again, we multiply out. This time it's $9,000. And then June 1st, we bought 800 units and paid $13 for each of those. 800 times 13 gives us $10,400. We do not include the sales here. We just want to know the total amount, number of units that we had available to be sold, and also the cost associated with those units. So we started with 300 units, we purchased 900, then 800, so the total of number of units we had available to be sold were 2,000 units. The dollar values associated with those units, if we add down, is a total of $23,000. So in all, we had 2,000 units available to be sold, and the dollar value associated with those units was $23,000. Now we're going to take that 2,000. I apologize, my lines here are just slightly off. We're going to take that 2,000 and separate it into 2 parts, sold items and unsold items, which we call ending inventory. Now, how would we find our sold items? Well, you could look at your chart here, and it tells you sold 300 on May 1st and 600 on July 3rd. That's a total of 900 units, and we would subtract that from 2,000 to figure out what's left. Alternatively, if you were in the real world, you could count the number of units left. That would be your ending inventory, and you could subtract from 2,000 to figure out the number of sold units. So again, to review that portion, to find out the number of units in our ending inventory, add together the number of units you sold, 900, and subtract from what you had available to be sold. The difference is what's left. What we're going to be doing for the rest of this problem now is splitting up this 23,000 of goods available for sale the same way we split up the units. What dollar value should we associate with the sold units, cost of goods sold on our income statement, and what dollar value should we associate with the ending inventory on the balance sheet? The first method, the Fifo method, stands for first in, first out. In this method, we state that the first things that we purchased are the first sold. So if we sold a total of, and I'll scroll up here, if we sold 900 units in all, I'm going to start by putting 900 there. We want to figure out a dollar value for those units. With FIFO, we say the first things that we had on hand are the first sold. So we first sold 300 of those units that we had on hand. Multiply that out to get 3,600. Oh dear. Then to make up 900 units sold, we must have sold 600 of these 900. Now, why do we only use 600 instead of the full 900? Well, because we only sold 900 units. And if we already sold the 300 from the beginning inventory, then we would only need to sell an additional 600 to make up a total of 900. Let's add the dollars associated, and using FIFO then, the amount of our cost of goods sold would be $9,600. Okay, now how do we calculate the cost of the ending inventory? Okay, if you're sharp, you might have noticed that I moved my arrows. I had an error in the worksheet. So let me scroll up here and get our cost of goods available for sale. This is the total value associated with the units we had available for sale, 23,000. If I subtract from that the cost of what we sold, 9,600, then I'll have the cost of what's left, which is our ending inventory. If we subtract that out, that would be $13,400. Now let's take a look at the Lifo method. The Lifo method doesn't seem to make a lot of sense. What it basically says is that, I'll scroll up a little bit so that you can see what we did earlier. The Lifo method states that the last things that we purchased were the first sold. This method doesn't seem to make a lot of sense except for perhaps products that were sold in piles, like road salt. You can't reach under the old or the new road salt to reach the old road salt, or perhaps coal. That might be another item sold in that fashion, or sand. But remember, you don't have to match the method to your actual cash flow. Management can choose whichever method it wants, and the primary purpose of Lifo, the reason it was developed, is to lower taxes, and we'll demonstrate that in a few moments. Okay, so Lifo stands for last in, first out. The last things we bought, 800 units here, were the first sold. And we had paid $13 for those. If we multiply that out, $10,400. Remember, we want to come up with a total of 900 units sold in all. Why? Because that's how much we said we sold. We got that number from the chart up here, sale of May 3rd and the sale of July 3rd. So we want to add up to a total of 900 units sold. We said we would have sold 800 of these of the last purchase if we were using Lifo. We need another 100 of these to add up to our total 900 units sold. So we're going to sell from the next most recent purchase. 100 times $10 each gives us $1,000. If we add that up, our total cost of goods sold, $11,400. Okay. Now, how do we calculate the ending inventory? Again, if the goods available for sale amount is 23,000, we can subtract from what was sold, I apologize, we can subtract from what was available the cost of goods sold, and that will give us our ending inventory, in this case 11,600. Okay, so you'll notice that the numbers are different. With FIFO, our cost of goods sold was 9,600. Our ending inventory was 13,004. We sold our oldest, cheapest units and had our more expensive units left. With Lifo, it's just the opposite. We're selling our more expensive units first, and we have our older units left. With the weighted average method, what we're going to do is take the dollar value of goods available for sale and divide by the units of goods available for sale. This is not a simple average that would give us the wrong answer. So 23,000 divided by 2,000 units gives us $11.50 per unit. To find out the cost of goods available, the cost of goods sold, we would multiply $11.50 times the number of units of goods sold, and that will give us our cost of goods sold. And that would be 10,350. To find out the ending inventory, we can either subtract 10,350 from 23,000 of goods available for sale, or we can just multiply out, again, the $11.50 times the units that remain, 1,100. Remember, we got that number here in step 2. And if we multiply that out, we'll get 12,650. So each method gives you a different cost of goods sold and ending inventory. Which one is correct? They're all correct because we're assuming a cost flow. Eventually, all the items will be sold and will end up on the income statement. It's management's choice as to which method they would like. So let's demonstrate the effect on the income statement of using the various methods. In step 4, we're asked to prepare an income statement using FIFO, LIFO, and weighted average. We first have to calculate the sales revenue, and to do that we would go back up to our chart of information for the problem here. We sold 900 units and they were $40 a piece. So I'm just going to type in the calculation for you here, 900 times 40, and that will give us 36,000 regardless of the method. It will be the same for all 3 methods. Cost of goods sold we'll get by going back up to the problem. With FIFO, the cost of goods sold was 9,600. With LIFO, the cost of goods sold was 11,400. I'm not going to put the minus sign there because it's slightly confusing. We'll know to subtract it. And with weighted average, the cost of goods sold was 10,350. So sales minus cost of goods sold gives us gross profit. With FIFO, the gross profit is 26,400. With LIFO, the gross profit is 24,600. And with a weighted average, it's 25,650. If we subtract out the operating expenses also given to us in our problem above, 19,500. The same for all 3 methods. If we subtract our operating expenses from our gross profit, we get income from operations of 6,900 for FIFO, 5,100 for LIFO, and 6,150 for weighted average. And this demonstrates the advantage of having LIFO. In times of rising prices, you're selling your most expensive products first. That gives you the highest cost of goods sold. And the only good thing about making less money when we subtract a large expense is that we pay less taxes. So LIFO, in times of rising prices, gives you the highest cost of goods sold, which is subtracted from revenue, gives you the lowest net income, hence the lowest taxes. FIFO will give you the highest income from operations and the lowest cost of goods sold. Weighted average will be right in the middle. After all, it is the average. So the income from operations will be right in the middle. So for our last question, which inventory costing method minimized income taxes? That would be LIFO. We're done with the problem demonstration. You have a good day.